Good evening, everyone. Time for another silver update. This is the daily chart of silver provided by netdania.com. You can click on the link below. And you can see I've drawn in the major uptrend line, a couple of downtrend lines to form this very, very large pennant. Perhaps the largest pennant in history. And I think when you see the topic that I cover here, that it's probably portending one of the largest moves in history eventually. But whether you draw it tight here, you can see you can draw the downtrend tight here where you get 1, 2, 3, 4 touch points and you ignore this outlier move here. Or if you draw it from the top here down to this move, it gives you a top line of either 30 or 33. So those are the ones that need to be penetrated to get moving to the upside. Now also we have a crossover forming in the MACD. You can see the crossover is forming in negative territory, and we've had a couple of moves into positive territory since the smackdown in September, but we haven't really had a significant break into positive territory except for this run up to 37.50, which was very short-lived. So we'll see if this breaks through to the upside and falls through on the zero line, something like this. That may be enough to get us through one or both of these lines to move to the upside. Now I wanted to address the main topic of the night, and that's going to be the random walk theory. We're going to go into that with some other charts, but I just wanted to cover that theory, explain to you how it works. There's a couple of ideas here. This is from Wikipedia. The random walk hypothesis is a financial theory stating that stock market prices, and that could be other markets as well, but commodities, but specifically it was about stock market prices, evolve according to a random walk, and thus the prices of the stock market cannot be predicted. It is consistent with the efficient market hypothesis. Now, the efficient market hypothesis is basically the idea that the market contains all known information, and therefore there are no surprises, since all the participants in the market, based on the known information, have already acted, that essentially you can't beat the market. Same sort of idea, and this is a couple of ideas that I think have been thoroughly disproven throughout history. If you read the book Market Wizards, you can see from the interviews with the top traders, many of whom, like Jimmy Rogers, consistently return triple-digit percentage returns over a course of decades, which is absolutely impossible by any odds that you choose to calculate. Would be impossible if this theory were true. But I want to show you a little bit more information about this theory. Now if we scroll down here on the testing the hypothesis section, you get this little section with a chart here, and this chart is a random walk hypothesis test, and the chart resembles a stock chart, so this is a random generated chart. Now that's very interesting because I'm going to take you to some charts in a minute here, but you can see by the shape of this chart, the first thing that strikes me is it doesn't look like any stock market chart or any market chart that I've ever seen. So I've got a couple of charts for you I want you to look at here, and this first one is a chart that I generated based on using some tricks, I'll say at first. But when you look at this chart, what I want you to notice about this chart is how unnatural to the eye this chart seems, whether it's these spikes coming up here and then brief recoveries and then spikes, or whether it's this downslope of rounding up, rounding up, rounding up, downslope, and then spike, 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 and then same type of rounding up. You can see very similar patterns here. Now the other chart, now that's actually a Dow chart, that's called the Dow chart, and this other chart is a gold chart, and you can see also on the gold chart some very, very unnatural things that you would not expect to see and don't really recognize in a chart. You can see a lot of these spike ups and fallbacks, and then same sort of rounding patterns that you had in the Dow chart. Now, the thing that these two charts have in common is that these are 180-degree charts and they're inverted. So basically what I did was I took the chart of the Dow, it's actually the Dow daily, and I just put it into a paint program and flipped it. So you can see this is the same chart basically. We'll go from this chart here, it has the indicator below, so we'll eliminate the indicator, and this chart. So you can see it's simply an inversion of that chart, but what this tells you when you look at the chart in an inverted way, that this is very clearly a pattern that you recognize. It's very common. You can see the way that it rises and also the way that it falls. Markets tend to spike on bottoms. They don't spike on tops like this. And if they do, that's usually the top. So it's very clear from examining these charts that the random walk hypothesis is clearly false, because if you can recognize that a chart is upside down simply by looking at the chart, then clearly it is not random. There are significant patterns, and of course the most important patterns are going to be the patterns based on greed and fear. Greed is what drives bull markets up, and fear is what causes bear market collapses. And those are the two types of patterns that we see very clearly in this Dow chart as well as in this gold chart. And this is the other chart that we inverted. And actually that's a closer up view. So anyway, that's the idea. So I wanted to go over to the question of the day, and then we're going to come back to some more charting. So the question of the day is from Simon, and he says, silver price manipulation by China. Hi there, Brother John. Thanks for all you do on this site. It's really great. Much appreciated. I read an interesting paper by Alistair McLeod in a posting on your blog in which he suggests, page 15 to 22, that it is China rather than JP Morgan and the Fed that are responsible for the manipulation of silver price. Your views on the following would be greatly appreciated. 1, whether you think he is right, and 2, if so, what are the implications for the future price of silver? My understanding has been the price has been suppressed by an oversupply of paper silver, but if this is not the case, can we still expect dramatic increase this decade? Has been suggested by the vast majority of experts. Link attached. So that's an interesting conjecture. I've talked about that a number of times in past videos as to whether or not it's really China that's behind it, or possibly more likely they're all actually in collusion with each other. Even if it is China, and of course what would China's motives be? Something similar along to what the US government's motives might be, is to provide silver to industry at a very low price because it's such a vital commodity that they want the silver to be available so that all of these technological advancements can be made and the common man can have all these things. That may be the motivation. That could be the motivation of China. Nevertheless, when you create a shortage situation by artificially suppressing a price, then obviously you're creating a much, much worse situation for yourself down the road when the shortages occur, and then you have the difficult ramping up time of all the mining. You have enormous price spikes as the market tries to adjust. So yes, it may be in China's interest in the short term to manipulate silver prices so that they can ramp up their manufacturing. But what does that do to them in the long term when they need to continue to manufacture even more consumer electronics goods, which require more silver? Where does that put them? And where does it put the United States government, who's now importing silver to mint the Silver Eagle? So I don't really see how it helps them in the long run, and for that reason it makes me wonder if they have a motive to be behind it. It seems to me still the strongest motive to manipulate the price of silver is to maintain its demonetization in the minds of the people and to keep the people from thinking about silver as a monetary metal, as an investment, as an inflation hedge, and as a deflation hedge, because there's just so little of it about that. If even a small percentage of the world's population started piling into physical silver, it would create such an explosive price move that it would not be able to be contained. So it's possible, but I have my doubts. Now back to the main topic, and I want to go over to an article by Hubert Moolman, and I cover his stuff fairly frequently on the blog. And there's a couple of charts here that are very, very interesting that he's covered recently. This first chart here, you can see that what he's done is he has indicated that a possible next price move target would be $80, and it's actually based on a very simple Fibonacci pattern. Of course, you can see here that it is a 1, 2, 3, 5 pattern. So you've got this significant line marked here at 10. You can see another one at 20. You've got another one at 30 where we seem to be holding now, and then you've got another one all the way up at 50. This marks a very clear Fibonacci ratio. If you know how the Fibonacci number series works, you take the first number and add it to the next number. That gives you the next number in the series. Then you take the last two numbers, add them together. So if you've got a 1 here, and then a 2, which is your 1 and 1 is a 2. If you add the 1 and 2, you get a 3. If you add the 2 and the 3, you get a 5. And if you add the 5 and the 3, you get an 8. So clearly silver is seeming to move, at least up until now, in this Fibonacci sequence. That would indicate an $80 price target if the Fibonacci series continues. Then of course you can see that it's a nearly exponentially growing number. If you have an $80 target, then the next Fibonacci number would be 80 plus 50 would be 130, and then after that would be 130 plus 80 would be 210. So you can see the price moves higher very rapidly if you're going on this Fibonacci series. The next chart that he has in this article is an interesting pattern that comes from 2007, and he's comparing the current pattern that we see this year to that pattern. Now, it's not a perfect comparison because you can see down here at the bottom that this chart pattern is showing from the month of October through the beginning of January, about 4-month time frame. But you can see on the upper chart you've got November 2011, all of 2011, part of 2012. So the one is about a 3 to 4 month time frame. The other one's about a 16-month time frame. So, but you can see the similarity in these trend channels. You have down move, up move, down move, up move, slight down move, and then a potential breakout. You have the same thing with this pattern here. So if we do follow this pattern, Moolman is predicting that we will have a violent or very rapid climb out of this trend channel once we break out of it, and that very well could set up the move towards $80 that the Fibonacci sequence seems to be indicating. So back to the silver price, we are right up to that support line that has been established a long time ago, even out on the weekly. If we draw that support line up, you can see we're very close to touching that line and potentially moving up from here, or we'll have to wait and see if we penetrate that line and head down to 21 to 22, which would be the next support level. And we'll talk to you next time.